Legendary investor Warren Buffett once said, "It's a huge structural advantage not to have a lot of money. If I managed only $1 million, I could make you 50% returns a year. I guarantee that." Buffett's problem, you see, at the moment is that he's managing hundreds of billions of dollars. Berkshire Hathaway, his investment vehicle, is worth almost $800 billion at the time of filming this video. With the fund that size, Buffett's investment universe is limited to large cap stocks. Those are companies with a market cap of over $10 billion. It is way more difficult to generate alpha, that is excess returns, when investing in large cap stocks. What Buffett meant was that if he were managing a small fund, he would have the privilege to invest in microcap and small cap stocks. This would easily enable him to generate 50% returns per year. Microcaps are smaller companies with market values between $50 million and $300 million, and small cap stocks have market values under $1 billion. For simplicity's sake, I will refer to microcap and small cap stocks as just microcaps. In this video, we will discuss why we are bullish on microcap stocks and then go over the attributes that we look for when picking successful microcap stocks. Hi guys, welcome back to the channel. If you're new here, I'm Bilal and I've spent the last 10 years working in finance in Hong Kong and Singapore. On this channel, we decode the mysteries of valuation and investing. If you find this content helpful, don't forget to like our videos and subscribe to the channel. As a disclaimer, this is not financial advice and investing in stocks is risky. Now, let's dive into microcap investing. When a stock is widely covered by analysts, a lot of the expectation is already priced in, so it's very difficult to find undervalued stocks. And this is the case for large cap stocks. On the other hand, microcap stocks, however, have smaller market values and are not as widely covered by analysts as the industry giants. This lack of coverage is what makes them a goldmine of opportunities. Some professional investors say that the world of microcaps is wonderful and often undercovered, making it ripe for discovery. At Fair Value Academy, we don't like to predict the macro and market moves. This is not our area of expertise. We are business analyzers and bottoms-up stock pickers. That said, we are very bullish about the outlook for microcaps and small caps from here. Let me explain why. In 2021, as a result of government stimulus and zero interest rates, we witnessed a massive bull market where almost everything rallied. From crypto to tech stocks to NFTs to SPACs, everything basically went up. There was a high degree of correlation and everyone was making money. However, last year in 2022 was a bit of a different story. Described by some as a killing field where most company stock prices collapsed. This was because of high inflation, which resulted in central banks aggressively raising interest rates to curb rising inflation. Interest rates are the reference rate for discount rates. When discount rates go up, valuations come down because the present value of future cash flows go down. This is one of the reasons for the market-wide drawdown in 2022. Even if you picked stocks with good underlying performance and earnings, most likely you would have lost money in 2022. Now let's talk about the second half of 2023 and beyond. We believe it's the ideal environment for stock pickers because this is where you can get alpha from picking the winning stocks from the losers, as opposed to last year where there was just a really high degree of correlation and everything basically went down. Here are a few reasons why we think microcaps are poised to do well from here on out. Number one, most of the interest rate hikes in the US for 2023 may be over. This is a huge relief for markets. Number two, the Russell 2000 index, a small cap US stock index, has recently picked up, outperforming the S&P 500 since June of 2023. Number three, we are likely to see some mean reversion. Those sectors that were killed in 2022, like tech stocks, are starting to pick up. However, it's not like in 2021, where you would buy any loss-making tech company with high growth and you would still make positive returns. It's not like that anymore. We believe technology is back, but only profitable technology is back. In this new regime of high interest rates and tight monetary policy, investors have to be very selective. Number four, and lastly, my favorite, valuation. The downturn in 2022 means that there are attractive buying opportunities from a valuation perspective for the discerning investors. Now let's talk about the attributes that we look for when picking a winning microcap stock. Number one, excellent growth rates. One of the primary indicators of a promising microcap stock is its expected growth rate. Successful microcap companies often exhibit the ability to compound at high growth rates into the future, positioning themselves to become the next generation of market leaders. The market is very forward-looking, so what we would say is that while the numbers this year are relevant, what's far more relevant to these stock prices is their expected growth rate in the future and what management is saying about the outlook a few years out. Number two, high margins. Profitability is key as the market seems to punish loss-making companies in this new environment of high interest rates. Successful microcaps should have high gross profit margins, which indicate pricing power, brand equity, and some sort of competitive advantage. And you want to see these microcap companies turning a positive net profit. In this new era where money is not free and capital is not freely available, those microcaps that are prioritizing cost cutting and moving to profitability will be favored by the market. This is very, very important. We are definitely avoiding anything that is burning too much money and needs to rely on the capital market, so that is going and raising equity or debt funding to sustain themselves because they are not free cash flow positive. Number three, clear competitive advantages. We look to pick companies with clear competitive advantages or moats that set them apart from their competitors. This could be in the form of cost advantages, brand loyalty, a developed ecosystem, network effects, proprietary technology, exclusive partnerships or licenses, or even distribution networks. This is super important as it gives us a level of comfort that the company will continue to grow and make profits in the future, which won't be easily eroded by the competition. Number four, large addressable markets. The potential market size matters because this allows the company to grow and expand, thus allowing them to continue compounding at high rates into the future and eventually becoming large cap stocks. Companies with global opportunities are better because they have the potential to tap into larger international markets. Number five, strong management teams. The importance of a competent management team cannot be overstated. We prefer founder-led management teams as they own significant equity and therefore deeply invested in the company's success, which reduces the age-old problem of agency. We also like management teams that provide conservative guidance. This means their profit targets are not overly optimistic, which allows them to consistently beat their targets and upgrade their guidance. Research has shown that companies that consistently outperform their guidance tend to trade at higher multiples over time as opposed to those that are less conservative. On the other hand, you want to avoid management teams that might be a bit promotional or overly optimistic, which in the past has caused them to downgrade their guidance or miss profit targets. We also pay attention to selective reporting and omissions. For example, if there's a metric the company used to report in prior year financial statements, say customer acquisition costs, and now they are no longer reporting it because it might not present the business in a favorable light, then we want to avoid those stocks. Any accounting irregularities or normalizations which are intended to make the numbers look better than they actually are. For example, WeWork was guilty of this with their community adjusted EBITDA, which was not reflecting reality. Lastly, on management teams, we look for management teams that are proficient at allocating capital. Basically, as an investor, we need to look for high returns on invested capital, which suggests that management is proficient at reinvesting its earnings to generate further profit. If management can't generate returns above the cost of capital, then they should be returning capital back to investors in the form of dividends or share buybacks. Number six, strong balance sheets. We avoid companies with lots of debt, more so when it comes to microcaps. Since they are typically early stage in nature, they don't have the capacity to take on a lot of debt. And I've seen having too much debt to be the downfall of a lot of microcaps. What's usually a bad recipe is a company with lots of debt and also burning a lot of cash. You want to avoid those. Lastly, valuation considerations. Valuation is always important. However, it plays out differently in the microcap space. Many microcaps are reinvesting their profits to grow aggressively and capture market share. As such, traditional valuation metrics like PE multiples, EBITDA multiples might not always be the best indicators. In fact, they make the stock look very expensive. And interestingly, some of the best performers always trade at high multiples and continue to do so because they are market-leading stocks and they're continuously reinvesting their profits, while the laggards trade at poor multiples, look cheap, and often have value traps and perform badly. If you watch the video linked on the screen, here we explain why we avoid looking at reported earnings multiples and what to do instead. A final point on valuation. A key driver of stock prices is earnings and earnings momentum rather than multiple. It's been shown statistically over time that what generates the market returns are dividends and earnings growth, not so much multiples going up or down. So if you can mainly focus on buying high quality businesses with clear competitive advantages and high growth rates, high profit margins, strong management teams, strong balance sheets, then you will do well, even if you're buying it at a PE multiple or EBITDA multiple that may seem very expensive. Because over the long term, these are the kinds of businesses that will one day grow to become mid caps and large caps. And naturally, your investment will grow too. That's if you're a long-term investor. At the end of the day, what's going to drive the share prices up or down is how they perform relative to expectations and what's priced in. So you really have to think about what's priced in and how the stock is going to perform relative to that. If you found this content helpful, don't forget to like our video and subscribe to the channel.